The last time we saw this happen, markets fell. Will they do so again in 2023? Well, today we take a look at 4 of the main reasons that could happen, along with whether the NASDAQ can be stopped at levels coming up. Obviously, the squeeze was on over the last 24 hours, but into trillion-dollar OPEX expiration and VIX expiration in the next 24 hours, there are some causes for concern. On top of all of this, we've seen something that has never happened before in the history of the NASDAQ versus the Dow. Let's get into it. Well, welcome back everyone to the Daily Show where we talk about stocks, commodities, and cryptos. Today, we're covering everything to do with the macro, news, lead indicators, and of course, hottest charts covering in the markets right now. If it's your first time here, welcome to the community. Subscribe and smash that like button if you find value in today's video, which I'm sure you will. We've got a lot to cover. So what is the thing that's never happened before? Well, the NASDAQ is currently leading the Dow, no surprise, but the margin is huge, and we have never seen such a thing before. The tale of two markets. Look at this. The first time the NASDAQ since launch in 1971, the index has been up more than 17% year to date through May 16th during a stretch where the Dow was still stuck in the red for the year. So this basically means that we've got markets upon markets. We know that the US 2000 is now market capitalization literally surpassed by Apple itself. We also know that if we take a look at the Dow, it looks sick. And we reported on this over the last 2 videos, where when we see the Dow and the Dow Transportation Index go down for 5 days straight, that rare occurrence has only happened in 2011 and 2020, both before a new sell-off had occurred. Now, usually what happens is we saw a squeeze into the sell-off. Last 24 hours, we saw tech stocks run again. Is that where the squeeze is? Well, it would make the most amount of sense. But let's have a look at some of the lead indicators going on in the markets right now into this week's OPEX. Trillions of dollars at stake, Friday expiration, with Wednesday being the VIX expiration. Very important that we know that the VIX is expiring on Wednesday, which could open up the floodgates for a little bit more volatility in what's been like a 50-day stuck market. I mean, 50 days. For some of you, you've probably never seen the market in such a tight range. Yeah, it's getting near those records again. That's what 2020 to 2023 has done, broken many records. Let's take a look at this one here, though. Exhibit A. We obviously see the market fall off here on high-grade junk bonds. 9th of Feb 2023. Now, if we load and overlay the SPX over the top of this, what you might notice is that sometimes the high yield junk bonds can actually front load a problem coming. Basically, when we see the bond market move in a way that is erratic compared to the stock market itself, we must be paying attention. A break here led to a bit of a rally and then a sell-off. Nice. Over here, we see a break. We've fallen a little bit, leading into an options expiration and a max pain that actually sits back down on these levels. So does this mean that maybe a sell is coming in the next couple of days? Well, we'll go through some of the evidence, but certainly high yield bonds are starting to show some cracks, and this is something we are paying attention to. What about copper? Well, Dr. Copper has also started to further weaken. This is in line with our demand destruction concepts. And if you've been watching the channel and following our concepts on where the big shorts are at the moment in the markets, it's of course been energy, the best performing sector of 2021 and 22 in some ways, up until the middle, is now not looking so good, is it? And metals, of course, as well. Metals getting smashed. Well, it makes sense. Demand destruction is here and it's starting to push down. And what that means is that the Federal Reserve's rate cuts are starting to have an effect on the market themselves. If we also go through some other bonds, here's a copy here of LQD, which is basically corporate yields. And I've just done some, kind of slight modification to it to show you that there is weakness here inside of corps. So basically the markets have started to make new lows. Now, when you get this and the stock market is hovering or making new highs and corporate bonds are not showing you that, again, it is time to be a little bit worried. Now, the problem is it's all about timing is everything. So if you're looking at the NASDAQ, you're saying, what am I worried about? This thing's going absolutely great. Yeah, but underneath the hood is very different. And of course, if you've been a put bear seller this year, it's been very tough if you haven't targeted the correct sectors or the correct markets. So in the medium term, or the kind of like next 1 to kind of 6 months, these signals, especially this one here from corporate grade bonds, is not positive. It's usually a negative sign. And again, it shows recession, it shows weakness, it shows bad numbers coming. And it generally means the bonds market is sniffing out something more than the stock market is. Always ask yourself this simple question: who would you trust more? The people that look at the balance sheets and the health of the company, or the people that just try to make profit? Once you've answered that question, then generally you can figure out which one of the signals you may trust over the medium term. And it's usually not the guys that want to make profit, which is the stock market guys. But do remember the saying that markets can stay irrational longer than you can remain solvent. Let's give you an update on central bank liquidity. The purple line here, you can see central bank liquidity is stagnant and the Qs continue to rise. Now, one of the main reasons the Qs have risen this year has been injection of central bank money. You can see here the huge injection and how the market instantly reacts just after that to this news and just goes ballistic. Top 10 stocks, AI stocks, QE-based stocks. That's what's really going. High gamma, it's all about that. Now, we're starting to approach a critical level, expected weekly options high, which is a range. Also, we're getting into our critical zone, which we'll look at later on. But I just want to zoom out here and just show you when it's not so much that you're going to be able to absolutely time it here, but just have a look at the way in which the divergence is starting to play out. Deep red divergence. So effectively, when you're looking at deep red divergence, you're starting to say risks are ahead. And I can understand that sometimes it's not like that, but this particular time, it is good to be potentially nimble and fast. And I'll explain that as we go through today's video. What about the skew? Well, this is one of the main reasons why markets haven't been able to fall. The skew keeps rising. The idea that black swan's coming, which is what this market particular index looks at, is kind of like continuously happening. And actually, put protection is expensive because people are having to protect into the debt ceiling in the corporate space, in the hedge fund space. We're looking for skew crushing. Remember August, remember April of 2022. I want to see the skew get crushed, which means that the squeeze has effectively done its job. We're seeing a little crush on the skew, but not a huge crush yet. I want to see that thing get smashed. And of course, I would suggest you potentially have it on one of your charts as an indicator. Let's have a look at move versus the VIX. The VIX has been suppressed, though it did allow itself to come out a little bit over the last 24 hours. VIX at 101 into the options expiration. And you can see the move index, which is the bond volatility, is very divergent. The diversion is massive, 94th percentile. I mentioned this in previous videos. Pretty rare to occur. Obviously means the bonds and the stock traders totally disagree with each other. VIX 1D could be something that you want to put on charts. We will look at a VIX a little bit later in today's video together so that you can start to see that actually not all VIXs are equal. And I think probably we need to start looking at VIX 1D and also VIX futures, because that's going to help us to see past this ridiculous compression that we got here. And why do we have VIX compression? Because there's too many calls. Everybody's betting on volatility. And markets don't like going down when everybody bets on volatility. Often when you're trying to short a bullish market, which by the way, markets are generally bullish. So just remember the stats are always in your favor to technically be an optimist. This year is one of those ones where being a little bit pessimistic might pay in the end. But of course, so far it hasn't if you've been in the top 10 stocks. Hedging against volatility, yeah, too high, and we need some of that expiration to occur. Luckily, it is starting to do so. Now, I've seen this chart going around a lot. Money supply, year-over-year change. Obviously, it's in the ground. We will do a special on it probably in the next video to see whether it's really going to hurt us. Now, most people draw back all the way into, I think it's like the 1940s with these money change things. I think the thing is, though, this time around, what happened with M2 is you can see this huge spike. So really, in terms of long-term trend, we're just trying to get back down to where we should be in terms of where the growth was in more normality times. And we haven't really been in normality since QE. But I estimate another 5 trillion could come off this sheet, and we'd still only be getting back to kind of more where we should be. So yeah, look, is it a big problem? Well, we'll investigate that tomorrow together. Let's also go over to our Twitter. Remember to follow at FX Evolution. Links in the description down below if you're interested. And I posted over here just an interesting stat. Obviously, VIX expiration is coming up. We also know that over the last 20 years, both this Wednesday and this Thursday, theoretically are actually bearish days. Now, that just means it's a statistic. If you see on your reasoning a reason to be bearish and it's actually coming through, just like the bullish statistical days, which I'll be sharing a lot more, so follow over on Twitter. I will share all these stats as they come through. It just can help you to gain further confluence in your particular selection if you have that signal. We also know that maximum pain for the market is sitting at 405 this week, which is obviously the best place for Wall Street to close the market to make the most amount of money. I keep bringing up this one, target rate probabilities. It seems like more economists are getting on board the idea of another rate hike. 22.5%. When we reported on this only a day ago, it was 20%. So some economists are switching into the idea that there's another rate hike coming after these speeches. And will there be one? I mean, I think no one will probably expect that one realistically, though it is starting to shift that way. The copper market and other markets, though, are saying we need cuts and we need them relatively soon to support the market if you want to be bull. Otherwise, what's this demand destruction telling you? Yields are going down. The curve is going down. In my experience, the Fed is always behind the curve. So what the market knows it needs and what the Fed ends up doing will be a big thing. Remember the dot plot, which we'll look at soon. What about sentiment votes? This will be the last time until we get a new sentiment vote. I just want to reiterate, when we get the vote coming through this week, I expect more bullishness, more neutrality, and less bearishness. At least that's what I'm hoping for. That opens up the idea that markets could go down. At the moment, though, with a survey like that, very difficult for the market to break out of its range. Do remember, depending on where you see recessions, also whether you think that we had a recession in 22 and then we might be going for a secondary recession, often the market will actually find a bit of its weakness during the recession and then turn. So you can see here 20 in all of the drawdowns, over 20% in the last 7 of 8 recessions. Most of the max drawdown took place during the actual recession and not the 12 months prior. So, of course, that actually checks out with 2022 when they changed the wording of recession. If you're not familiar, that's what they did, and they kind of broke the system, in my opinion, with using the word recession. But if we get a double dip, well, does that mean we have to go down again? Again, something to keep in mind. We don't have a new dot plot yet. Looking forward to seeing the new dot plot and what the members are saying. But basically, the participants of the FOMC or the Fed, they keep saying the same thing. We're going to hold. We're not cutting this year. I mean, they keep saying it. The question is, do we believe them? The market doesn't. The market's saying there's a cut this year still. They were saying 2 or 3 cuts. I don't believe that there is more than 1 cut this year possible. We'll find out. I could be wrong. It's just my opinion. Obviously, I'm thinking about it, trying to put the pieces of that puzzle together along with you guys here on the channel. Forward PEs dictates that I'm not interested in the market at this stage. I think it's expensive, but it is a tale of 2 markets. There are both cheap stocks right now and individual stocks. Some of them are very interesting. And there are ridiculously expensive stocks. And you're kind of putting 2 and 2 together and saying, well, is it actually this expensive, Tom? Well, we'll be looking, I'll break down the forward PEs when you take out the big one, and you might see that actually the market is more efficient than you think at pricing right now. In terms of earnings releases, just remember these are the implied volatility of the earnings coming this week. I left it out of the other video, but SE kind of got smashed again. So showing that kind of ridiculous, overpriced on these particular stocks and how they've come down. Consumer demand is obviously dropping there. And then we've got Target, we've got Take-Two, we've got a few others that are coming out this week. So certainly still, we are in earnings season. They're the implied volatility moves based on the options price. What got hit most in the last 24 hours? Well, more of the ones that we have been hating on together as a channel. So energy down big. No surprises. Metals down big. No surprises. Gold broke the double top. Interesting. Will it continue to weaken as GDX? And then, of course, we have the ones that have been most favored recently. Technology stocks are the only things that have held up over the last 24 hours. When we look at the last 5 days, I mean, it's been certainly a big tail here. Energy, metals, smashed and probably going to continue to get smashed. They are in pretty big sell-offs at this stage. They will become opportunities in the future, but it's all about timing. And look at that tail, so different between the technology stocks and the metals and the demand destruction. That's why on this channel, I really want to talk about how you can actually be a bear and a bull at the same time. Just like Druckenmiller is sometimes like that. He'll buy a lot of stocks and he'll hold them. Like I might buy, let's say, I don't know, Australian stock, maybe CSL, and hold it throughout, calamity and problems and stuff because it's a relative defensive. But at the same time, I might be selling iron ore stock. These are the types of things that you can be doing. Long, short, all sorts of stuff, even with your bias, if it is even bearish or bullish. So just before we jump into the charts and we take a look at all of the key levels we should be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, Tiger and I have done a little bit of a deal. You might know that I like Microsoft stock. And if you're an Australian viewer, well, luckily for you, you are one of the beneficiaries of this. But don't worry, if you're from anywhere around the world, you can look at the special offers in the links down below. If you fund with as little as 1 cent for now, you get an additional $25 worth of Microsoft stock. And if you fund within the first 7 days of $1,500 and you're from Australia, you'll get an extra US30. But where does it really change? Of course, getting bonuses is always nice, or special offers, but I like some of the features inside the platform as well. So let's take a look here at one of the features, and I think this is something that a lot of people would like to use. Firstly, popular stocks. It's always nice to know what's really running these markets from a retail perspective. That may allow you to get involved in the trend sometimes, and even sometimes potentially counter it. At the moment, we seem to have some popular stocks in AMD, Yelp, Google, Amazon, Oracle, Nvidia, and of course, many of the other big names. But what about if we could screen some of these and we could add different filters and then save them as a strategy? Well, luckily for you, you can do so in the Tiger Brokers platform. You can select volume, you can select PB ratios, you can select market capitalization values, which is something I always like to do, and then scan an incredible range of stocks to try to find something that might interest your particular strategy. So if this is something that interests you, then why not check out Tiger Brokers today? And of course, give them a little bit of love for supporting the channel. All right, well, let's jump into the charts, and we'll start off here with the VIX June Futures Index. You can see it's a very different story to overall the VIX, and sometimes I think it's worthwhile at this stage to get outside of the VIX and to start looking at the futures. You can see the futures have jumped over the last 24 hours. We're starting to see some volatility come in here. In comparison, if you look at the VIX here, I feel like this low is pretty much peak complacency at the moment, but yeah, it's being crushed because there's too many calls on it, and that's what's doing it. So if you want to load up VIX futures, you could put them on the charts. Did we see weakness over the last 24 hours? Yes, in the RSP, so this is the equal weighted S&P 500, where we don't put so much emphasis on the tech stocks, we actually almost saw a new low. Now that's interesting because we, of course, have not seen a new low on the S&P, nor have we on the Qs, and the Dow's kind of teetering on a similar level. So if we go down, are we going to open the floodgates for a sell to 137? I think that is possible, and we'll talk about why that's the important factor here when we look at the S&P in a moment. TLT, I want to bring up treasuries. I still think treasuries will get beaten into the debt ceiling thing. Now, if debt ceiling does get sorted, treasuries could do okay, but treasuries are just coming under this so-called risk banter. I'm not actually won over by the whole fact that there's risk, but I actually think it's going to go kind of like this. And the reason why I say that is because if you look back in 2011, which we can do here, you can see what treasuries did. Treasuries had that really nice period of time. Well, we'll just go over here. 2011. We actually get in the right years, guys. All right, there we go. That's the one I want. So basically the markets, you can see, dropped off a little bit in terms of treasuries. They kind of stagnated for a period. We went into the debt ceiling issues that were around here, and then we saw a big spike up in treasuries where they did really well, counter to what a lot of people thought when we had, potential problems with the government. So treasuries could be interesting. 100 is kind of where I feel like they could go though. What about the US dollar? Let's have a look at the 2 hour here on the US dollar. Nothing different at this stage. The dollar gave us a monster weekly, and I was liking the idea that the dollar may come down to this interesting bull zone. I also don't mind it to do this and this. But at this stage, it's still bullish. I mean, this closure was so significant, showing us the dips should be bought. I mean, that almost closed right on the high after such a big day. So, yeah, I think that that's the same thing for the dollar. I'd like a deeper pullback. I'm being patient on that one. Gold, ooh, almost there. Yeah, look, gold is almost at the most traded zone, heavily traded zone. This is exactly what we expected. Good. Markets coming down, gold going down in this case, and coming back into a very interesting red zone for if you are a gold buyer. So that is, if you like this kind of area, this will be very interesting to look at. Well, I am going to watch gold through this stage. We don't have any reason at this stage to buy it. I'd like to see it hover. dump into this, possibly wipe every stop off here, rally back through, and that to give us the go ahead, basically the V shape to go ahead with a potential buying gold up until, these ranges. But yeah, this is in line with everything we've been talking about. Weakness, people attacking in the comments, all sorts of things. I got shellacked for the gold call on being at sideways to down. But you can see how it plays out. Unfortunately, with gold, it's super manipulated. We know that this is a tough place for it to get through. And although I remain $3,000 strong over the next couple of years, I just think that we're going into a period of weakness for gold. And that's why we get into this sideways market. If we bust some weeklies, I'm open to it coming through very strongly. What about natural gas? It's done kind of what I would expect. I actually think that we might find a little bit of weakness here. Obviously, this looks like a shooting star. I'm looking for the market to get through 260 and then maybe start ramping back up to the threes. So the Widowmaker does that. I kind of suspect it does more this at this stage. It's had a nice run up. Good. The base holds for now that we've talked about. Good. The stats were in the favor over the medium term. So that's the next months and months and months for natural gas. However, I do want to remember or remind everybody that it is a rolling contract and you get brutalized in rolling contracts. If we go to oil, which is a little bit of a different market, I'm still pretty negative on oil, at least oil stocks. And you can see here that we've got this kind of supply build. I think if we bust that, we go up to around 73. That's where the sellers could be. Otherwise, we could go all the way back into 75, 76. At this stage, oil is a bit tough to call on which direction in the small timeframes. If we go over to the energy stocks, I kind of still think these are coming down, probably looking at them potentially making it all the way into the 76 lows. And then if they bust 76 lows, we're probably going back down to 68, 70. So this is really doing well. I'm pretty happy with that short. And obviously it's counter to a lot of other people's thought processes, which just again shows you why sometimes it's worth thinking outside the box on some of these things. Tesla, it's really hard, guys. Tesla is difficult. We knew when we thought we were going to be bullish up into the 180. We got to the 61.8 fib, the gold pocket, the expected weekly options high. We didn't get 180. And if we actually have a look at the options themselves, and we'll refresh this for the OPEX 19th, let's take a look at this. And it's, of course, lagging there. Let's get it through. The 180 is so call bought, and the 160 is fairly put bought. So hovering in this zone is fair enough for Tesla. And if we go back over to the stock, there's nothing spectacular about the last 24 hours. We didn't even manage to get through 170 here, or 169.83. I feel like that might be the go. We get through this, buyers get control, they start pushing up, try to get towards 180, not above, I would think this week, but above that point. The other argument is, of course, back down to 145. I still remain 145, 146 on the medium term. I think that Tesla is going to come into trouble as competition gets up. Amazon's been my one bull pick this week. So, yeah, it keeps going here. Oh, and Google, I guess, from last week. So those are the two big ones. And they continue to get decent ramp. We can see here on the daily another nice closure. And actually fairly significant. It's closed above this previous daily. So Amazon could even have further squeezy into it or further move into it. I'm looking for 120 here. It's hard to go bullish when you're thinking bearish, but the weekly does show you a nice breakout on the last week. And I think this is a momentum style play. Good day for Amazon. Before we go through these other stocks, I want to just quickly load up Google. So we're going to, actually, we'll leave KRE on here and we'll go to Google in a second. KRE, which is, of course, regional banks. We like this low. It rallied. I still think there's more potential in KRE as it is fairly dipped, but it may hover for a while. And the one problem with sometimes these, buys of these extreme lows is although this is a pretty good level, if this starts to turn into a Wyckoff, it could do something like this, be sitting for a while. So again, you need to be aware of that. Yep, a day down, 1.49, still stronger than the rest of some of the things that sold off, but KRE was down. And around here is where you usually expect those buyers to come in. Let's take a look at Apple. Still a potential for an island reversal. If the market got shellacked in the futures, which I don't think will happen over the next 24 hours, but maybe after VIX expiration, who knows, then you've got a chance of an island reversal. Will that be the signal that breaks the camel's back? There is no reason to sell Apple just yet. I don't have a reason. Maybe there's some small time frame. I'm not interested. It is still in an uptrend. And as you can see, I just think we're in a point where people would scale back if they had large positions. That's funds kind of doing that type of thing. When we move over to Disney, it's still suffering after its bad earnings. This is a very interesting line for investors. I'm not closed to the idea that Disney could fall to 78.71, which I think would be pretty sweet. And maybe even I would be a little bit interested in Disney again at that point. But yeah, we're looking for it to hover and hold this position, then to range gap out and to give us that kind of execution towards some bullish action again. But yeah, it's form-based. You can see the volume is there in some of these actions around these levels. I'd say someone is accumulating. It's just whether they're in charge at this stage on this stock. Let's have a look at Google now, just to point the point of view here. I still don't think we're in the turn yet. Google is doing really nicely. Obviously, we reported on this with the breakouts that occurred. It's been momentum play. I don't want to buy the drop on the momentum play. Often when they're ramping like this, when it comes down, everybody else says, I'm going to bid a D, guys, bid a D. Well, not so sure about that one this time round. But look, I'd like to see Google go a little bit higher, 123.25. It's in our red box. You've got to be careful here. But certainly, it's continuing on that trend at this stage. Gold market, you can see the double top. You can see technically the confirmation of that. You would think rallies are going to be sold now on gold stock. That can be different to gold spot, but certainly gold stock has theoretically broken a double top here. Double top patterns, they're okay. They're not amazing. You can get a lot of false breaks on them, so you've got to be a bit careful. But yeah, basically that's what it's looking like. And at this stage, gold looks a bit weak into a period of weakness that usually finds. XJO is down, no surprises. This for the Australian viewers. Yeah, I still think this thing's going further. Would like to see today get a bit more smashed. I don't want to see more wick purchasing here. That shows you maybe orders are coming into the system. There's the low. I'd like to see a closure underneath that point. So I'm just going to write that in there. There it is. So that's about 71.85. I'd like to see like a close underneath that level, and then that to really show us further weakness in the Australian market due to copper, due to metals, due to energy, all of these types of things. For DAX traders or Euro traders, what can I say? I mean, I'm barely looking at this chart. It's just stuck. And until it gets out of its little coily range, we can't say much. IWM, terrible day for it. Closed on the low, which usually says more weakness is inbound and rallies should be met by sells. Now, that's just as a day trader, as somebody that's looking at these markets, but IWM closed on the low, not underneath the previous ones. I would have liked to have seen that from IWM. And you can see here again, the futures market didn't quite close in the low. It bounced a little bit after hours, still stuck in the range. Let's have a look at the Qs. Now, the Qs sold near the end. Beautiful rally, huge squeeze. Almost pushes into our expected options weekly high, certainly getting into that top end range. We look at the NASDAQ here, you can see it's not quite in our extreme zone, red. So I guess we have to still assume that it's going towards the red zone and more squeezes could come here. But as we move over to the SPX, we can see again, central bank liquidity, the market, the daily close below the previous daily closes. And I want to jump over to the futures market here to have a look at this. So the futures market finally, at least there's some close outside. Does that show us that the market is potentially going to go down? Well, the weight of evidence is, of course, closure on the low. So that means that if the market was open any longer with real big trading volume in it, would they have kept dumping it? Question. The next thing is we know that max pain is sitting at 405, which obviously brings us down into these levels, which would be, of course, the demand and still within the big range. So that's certainly very possible by Friday. And if we have a look again, daily closure is something that, we're looking at. We know that the 61.8 fib of the high to the low has been this zone where we're trapped. We know this is the most heavily traded zone. We also know that 4100 has been the wick purchasing. So as a buyer, what would you be looking for here? Well, as a buyer, obviously you'd want it to smash this high and keep going. But I would kind of like the first thing to happen is probably futures come in bullish, then futures to potentially be sold off after creating the gap so that we can get a gap fill on the session. That would be pretty nice. 4,100 is where I could see buyers recommit, but they were very committal during the first time, less committal on the second time. You can see the big wick here, the less, kind of speed that it went up. So I think that the third time, often that's where you do see closures below. And I think the reason would be we still do have a series of lower highs coming through. It's not like it's higher highs, they're lower highs. Each time it rallies, it's getting sold at the same point. So you get a futures market in, retail traders get all excited, maybe we sell down. Big question mark whether buyers can commit there. And then, of course, can we get back into those 40, 60, 40, 50 zones for lobster dinners for all of Wall Street option sellers? Well, I would say that could be what they want to do. At this point with the daily close, that is kind of the evidence that we're getting. I'd call it like a 6 out of 10. It's not the worst. It's not the best. It's been pretty tough in this range without having really good patience to be able to react. I mean, there are trades in here, but you've just got to be really good at figuring them out. And that's been something that has made it kind of tough. When you're doing a daily show, you have to actually be there at the minute with the set alerts. That's the kind of way you're having to do it. If we take a look at this week's options expiration, 400 puts remain the standout. Lots of calls. Too bad, so sad for all you puts. Too bad, so sad for all of these calls. Very unlikely they're going to make any money. Some people in here, depending on their price, may make a couple of bucks. 405 is the maximum pain. 400 is a wall. I doubt we get through that one. No one would want to pay the lobster dinners. And if we move over to the crypto market, is it giving us any inklings here? Well, not really, because the crypto market has continued to sell off this area, which is fine. I'd like to see it go underneath this set alert zone here and then rally back to this area where it is right now. And I think if that happens, some pretty nice sells could be in. So that's the way I'm looking at Bitcoin at this point. Certainly something that we're watching. If we go over to the calendar for the week ahead, what else do we have going through? Well, obviously we saw retail sales. That was a little bit lackluster. I think it was 0.4%, a little bit under what they expected, showing some demand destruction. We do have VIX expiration on Wednesday. Then we have unemployment claims coming on Thursday, which is 8:30. Shouldn't move the markets too much, but sometimes it does. Bunch of bank holidays, maybe some illiquidity coming into the markets. Interesting. And then we go here to Fed Chow, the Papa Pal, and millions of FOMC members having a good chat. So probably with all these FOMC people, they're all just going to say, we stick to the dot plot. And then this guy or this person's going to say, we stick to the dot plot. We stick to the dot plot. We stick to the dot plot. I would say something like that is occurring in this market. It is what it is, but we'll see them come through. If you liked what you saw on this channel, make sure to subscribe. Smash that like button, guys. 3 free trading cheat sheets as well. You can sign up over here. We do have a day trading masterclass special offer if you want to know how to extract out of that little range. There's been some good success in our community, so you can definitely check that out. And of course, I'd like to say a big thank you to the sponsor of today's video again, which is Tiger Brokers. Check them out. Links in the description down below. And if you're from Australia and you like a bit of Microsoft action, then you can get some special offers there. Thank you and bye for now.